why relying on national debt to fuel growth, something we've done for ages, could completely change how we look at fundamental economic security, even national sovereignty.
Well, it's really the defining paradox for advanced economies right now.
Yeah.
We're sort of past observing simple economic cycles.
Yeah.
What we're actually watching is, decades of, let's say, questionable policy decisions all converging.
Yeah.
And they're creating these three really distinct pressure points across the G7.
That's a great way to put it. And today, we are shifting focus a bit, moving past the usual US and China headlines. We're going to synthesize some complex global data, try and analyze three critical zones of stress.
Okay.
So there's the UK's really debilitating fiscal trap. Then there's this quieter liquidity crisis building up in US commercial real estate.
Right, the stealth crisis.
Exactly. And finally, this, well, frankly, bizarre leverage struggle playing out between the EU and China over critical supply chains.
And the thread connecting all three really is this rapid transition we're seeing. We're moving from that debt-fueled growth, which honestly felt almost limitless for decades, to a kind of debt-mandated stagnation.
Yeah.
And that's now limiting the fundamental choices of, pretty powerful nations. Our goal here is just to break down these interwoven trends into clear insights for you.
Okay, but before we really get into the weeds with the data, just a quick reminder. If you find this analysis useful, please do subscribe and stay engaged. Your support is genuinely what allows us to keep bringing you these explorations into, well, the core mechanics of the global economy.
Absolutely. Okay, so let's start across the pond with the UK. The economic picture there is, well, perhaps the most precarious.
Why precarious specifically?
Primarily because they're stuck. They're in a high debt situation, but crucially, without the buffer of a global reserve currency. And that changes everything.
Right. So when you say high debt, what does the data actually show? How does the UK's borrowing pace stack up against, say, the US?
The comparison is pretty stark, actually. Over the last 20 years, British debt to GDP, it's grown by an incredible 57.4%.
Wow.
Yeah. That's a higher rate of growth than the U.S. experienced. Now, the U.S. can, print money to help service its debts.
Reserve currency advantage.
Exactly.
Yeah.
The U.K. just cannot borrow or print its way out of this hole without immediately triggering an even larger, probably more destructive inflation crisis than the one they're already grappling with.
Which puts the government in an incredibly tight spot, especially with reports suggesting this fiscal black hole, potentially over £30 billion. If you can't borrow easily, the only obvious path to fill that gap is raising taxes.
And this is what we're calling the deadly fiscal trap. It's a perfect description. The government can't really go back to the markets for more borrowing without interest rates spiking, which just suffocates investment further.
Right.
But the only other lever, raising taxes, well, that strips away people's consumption power. It makes the already struggling economy stagnate even more.
So they're basically choosing between two bad options.
Pretty much. They're choosing, it seems, a slow, painful economic slowdown over risking an immediate, potentially catastrophic financial meltdown.
That's a grim choice. And the expected fallout from higher taxes is this idea of capital flight, right? Which just makes the problem worse. We saw that UBS wealth report forecasting nearly 500,000 millionaires might disappear from the UK by 2028.
It's a massive potential hit to the future tax base.
Yeah.
And it's not just the numbers.
Yeah.
It's the qualitative loss.
Yeah.
Capital brain drain.
Yeah.
Capital rarely comes back once it leaves. And the departure of high net worth individuals, that's severely impacts future consumption, future innovation. We could be looking at a really sustained period of low growth, not just a temporary blip.
And the forecasts seem to reflect that pessimism. The IMF's outlook for the UK is, well, it's very grim. Just 1.1% GDP growth expected for this entire decade.
Which would be the lowest 10-year growth rate in a century.
A century. Wow.
And this stagnation, it's the function of a few things.
Yeah.
Poor innovation, definitely high energy costs, and just failing trade diversification.
Can you give an example on the trade front?
Sure. Look at the specific data. UK exports to the U.S. hit a 3-year low back in August, dropped about $900 million, partly thanks to ongoing tariffs.
Okay.
Meanwhile, exports to the EU fell 5.3%. Why? Largely because the EU is choosing to source cheaper goods from China. So their trade strategy is actually kind of undermining their attempt to escape this fiscal squeeze.
Okay. So the UK situation really highlights the limits of sovereign debt and maybe the inability to generate sufficient income right now. Let's pivot then. Across the Atlantic, let's look at the pressure building on core U.S. financial assets. You called it a stealth crisis is brewing in commercial real estate.
Yeah, and what's fascinating here is that even though the U.S. does hold the reserve currency advantage, it's facing this really profound threat to the stability of its financial assets, and it demands a pretty rapid policy response.
And the key data point here is, well, it's genuinely concerning. Office commercial mortgage-backed securities, CMBS, right? These bundles of loans backed by office buildings.
That's them.
Delinquency rates are now at a record 11.8%. That's higher than the peak we saw during the Great Financial Crisis back in 08-09.
It is. And this raises a really important question. Why isn't this causing an immediate banking panic like 2008?
Good question.
The key difference, really, is that today, the big banks, they largely sold these office loans off years ago to investors, to funds.
Okay.
So while it's maybe not a direct systemic risk to the major U.S. banks themselves, it is a massive liquidity risk for whoever bought those loans,
Which includes?
specifically institutional investors and, crucially, pension funds.
I see. So the risk isn't necessarily the banks collapsing again, but it's the value of assets held by, say, retirement funds, potentially just evaporating.
Exactly right. When these properties go into distress, it's the bondholders who get clobbered, especially when the properties are sold off at fire sale prices. We saw that specific example with the Palisade Center Mall.
Right.
A distressed debt fund seized control, and the subsequent repricing of that debt. It resulted in over $230 million in losses for the bondholders.
And what was particularly shocking there was that even the supposedly safest investments got hit.
Yes, even holders of AAA-rated bonds, the highest quality slice, they suffered a $72 million hit. AAA is meant to be rock solid.
Wow.
So that suggests that even the most secure parts of these structured debts are vulnerable right now. And for you listening, this matters because those pension funds, they hold the retirement savings of millions of ordinary people.
Yeah.
If that huge pool of liquidity gets spooked, if it spirals, well, that has really widespread effects on confidence, on spending, everything.
So what does this vulnerability in U.S. assets ultimately mean for, say, U.S. monetary policy for the Fed?
Well, it creates enormous pressure. It definitely hammers down the overall demand for U.S. assets internationally, and it puts pressure on U.S. authorities, likely the Fed, to bring interest rates down maybe quicker than they'd like, just to prevent widespread defaults.
To ease the pain.
To ease the pain and stabilize things. The financial reputation of core U.S. assets is taking a serious hit here. It indicates this delinquency crisis is potentially far more dangerous than anything we've seen in the commercial property space for maybe the last 25 years.
Okay, so that covers pressure on sovereign income in the UK, pressure on U.S. assets. Let's transition to our final area of global economic fragility. This awkward leverage struggle involving the EU and China.
Yeah.
This one seems rooted in supply chain dependence. And you mentioned, of all the G7 economies, the EU probably has the least leverage here.
Oh, clearly. Their actions really reflect that deep-seated desperation, I think. They're apparently contemplating a truly, well, bizarre maneuver.
Bizarre how?
They're thinking about pressuring Beijing to ensure their supply of critical materials, think rare earths, minerals, by basically requiring Chinese exporters to include these materials in shipments of other goods, like, say, electric vehicles coming into the EU.
Wait, hang on. They want China to guarantee critical materials by packaging them with cars? That does sound desperate.
It really confirms their severe vulnerability. Look, energy costs are so high that even powerhouse Germany has to subsidize its industrial base until 2026.
Right.
A critical material shutoff. Industries could literally grind to a halt in months. They just don't have the financial flexibility or maybe the political will to build new mines quickly. And strict environmental regulations make building new refineries in Europe almost impossible right now.
So they're stuck.
They are contorting themselves just trying to secure necessary materials from the global supply chain, mainly from China.
And meanwhile, China holds immense leverage in these areas. We've seen their supply chain seem robust enough they resumed global supply of legacy chips despite export curbs.
Exactly. And you have major German companies like Volkswagen basically rushing to China to get chip exemptions just to keep their car production lines running. The EU's auto sector is incredibly dependent on China at this point.
It's this paradox then, isn't it, between the EU's approach.
It's striking. They're publishing foreign relations papers, using pretty hostile language, restricting tech transfers, calling China a decisive enabler of the Russian war.
Right, tough talk.
While simultaneously needing China desperately for strategic sectors. Critical raw materials, industrial magnets, semiconductors, the list goes on.
It's this constant clash, hostility versus absolute economic necessity. And if we connect this to the bigger picture, The source of this panic, this lack of leverage, does it stem partly from cutting off Russian supplies?
That's the crucial geopolitical context, absolutely. Cutting off Russia removed a potential alternative source for some of these necessary rare earths and maybe land for refinery development outside of, say, China or strict EU regulations.
So the EU has kind of sandwiched itself.
Economically and strategically, yes, through decades of arguably poor energy and supply chain diversification choices. The fundamental issues across the G7, the UK, the US assets, the EU supply chains, it's really decades of accumulated debt and risk finally manifesting today in these three distinct escalating crises.
Okay, so let's try and bring it all together then. We've got the UK seemingly unable to maneuver out of its debt trap because every potential solution, borrowing or taxing, just seems to lead towards deeper stagnation and maybe capital flight.
Right.
Then we have the US facing this growing liquidity threat in its core financial assets, particularly commercial real estate, which pressures them towards lower interest rates to mitigate risk, especially to those institutional funds.
Yep.
And finally, the EU, caught in this really awkward dependence on China for the very materials that power its core industries, leading to these, let's call them creative policy ideas.
Creative is one word for it. Yeah. This systemic fragility across these major economies leaves us with a really provocative thought for you, the listener, to consider.
Okay.
If raising taxes drives away capital, if borrowing more risks national solvency, and if trade diversification seems to be failing, what are the few remaining effective levers in an advanced economy, especially one without a reserve currency like the UK? What levers can they possibly pull to engineer genuine, much-needed productivity growth?
That's the critical question, isn't it? What's your take on this triple threat to global economic stability? We'd genuinely like to hear your point of view. Share it. And if you haven't already, do subscribe so you don't miss our future analyses. We'll see you next time.